Hello again, everyone. This is Ken Weber, president of Weber Asset Management. Today is Monday, April 17th, 2023. I'm here in New York, along with my partner out in Lake Tahoe, Jack Bowers, our chief investment strategist. And let's just jump right into what for many people is the key issue in terms of the financial world. By the way, parentheses, let me just say, in this session today, we're going to talk about a generic topic that many of you ask about. So stick around for that. Getting back to what I was saying, there were several reports about inflation that just came out in the last few business days. And Jack, let's just jump right into that because it was basically good news.
Yeah, I think so. It wasn't necessarily reported that way, as everybody would like to see inflation coming down faster than it is. However, I think we saw energy helping. We saw used cars and trucks helping. The only thing that didn't help was really the rent component, which accounts for a large share of the overall index. And one reason for that is that the rent surveys tend to have a process that lags the results by about 12 months. But we've already seen evidence that rents are falling in some markets. And so I think over the next 12 months, it's a pretty certain bet that the rent component will be declining as well. So I think we can look forward to inflation continuing to decline over time. I think the worst of the inflation problem is behind us. And I think it's an optimistic backdrop. We don't know exactly when the Fed will be done with the current tightening cycle, but we're close at this point, and I think the markets are going to factor all that in.
Yeah, I agree. The producer price index came out late last week, and it was good. I think they were talking about core inflation in the 5% rate range, annualized. Yeah. And so that's a nice little decline from where it was a year ago or so. And so the trend, at least, who knows what the next few weeks will bring, as the reports come out or the next month, but at least we can say the trend does seem to be favorable.
Yes.
In terms of inflation. And for many people, for many market watchers, inflation is more or less the key indicator, because if inflation stays high, the Federal Reserve will keep interest rates, keep bumping them up. And we don't want that. The market does not want that. Right, Jack? I mean, that's a key driver.
Yeah, I think where we are at now, we might see one or two more quarter point increases, but we're very close to that terminal rate that everybody's been watching, and it is going to probably happen in this 5%-ish range. So I think we can at least know that the worst of this cycle is over. And this is at a point in the economic cycle where, investor attention would tend to turn toward the new opportunities going forward. And so I think there may be a lot of kind of bearish signs, but you normally see that around the time that the market is beginning to turn up for the next cycle. So we may not see as much of a lift as we might have seen in the past at this point in the economic cycle, but I think we'll still get that lift because we're doing well on a lot of fronts. Capital spending is holding up pretty well. Consumer spending is holding up well. I think, as long as we're on the downhill side of the inflation battle, it makes sense to stay in stocks.
Yeah. I've told some friends, it's a minority view, but my position is that there is at least a 50-50 chance that there won't be any more rate increases. And if there are, it'll just be one more quarter point increase.
Yeah.
So on the record.
Yeah, it's really hard to know exactly, but
very hard.
I think the market is in a good enough spot where it is right now that nothing is really going to be terribly bad news, no matter how it plays out. We're currently experiencing a fairly bleak earnings cycle where the year-over-year corporate earnings are down, in the 5% range. But we went into this with very low expectations. So I'm not sure that, even this hard news is going to be all that market moving.
Right. And what the Fed is up against, ironically, it's good news. That's bad news is the unemployment rate is at historic lows. It's around 3.5, something like that. And that 3.5% unemployment is very good for the average person, but ironically, it's bad for stocks because that's too good for the Fed, and they say the economy is overheating and all that. And you really have to be an economist to understand how that makes sense.
Yeah, it's
So-
kind of, semi-balanced. We have layoffs occurring in the high-tech industry primarily, but at the same time, hiring occurring among smaller companies and especially in blue-collar type jobs. So I think the Fed has achieved their goal of knocking out wage inflation. And really, it's just a question of seeing if time does the trick for the rest.
Yeah, Jay Powell he used to seem moderate, the chairman of the Federal Reserve. Lately, he's come across as quite hawkish.
Yes.
And so that does scare me, but it looks like other people at the Fed are a bit more dovish, and they're willing to, let things play out for a little longer. But,
right. And even Powell has admitted that, this is kind of a wait and see period at this point. If things keep going as they are, I think it's going to be a potential for a soft landing. I think the current forecast is still a 60% chance of a recession. But if we do get a recession, it seems like it would be fairly mild. I look at all the capital investment that's going on, and there's a lot of money being spent by businesses in the automotive sector, in the utility sector, in the energy sector, and even a lot of high-tech investment being made for AI. So I think that's going to help. The fact that consumers are still spending because they have kind of full employment and wage increases behind them, that's going to help. So I'm still optimistic we'll get that sought after.
So we can put Jack Bowers down in the probable soft landing. Yeah. Yes.
I'm always the ball.
Always optimist. And I'm kind of there too. I think the soft landing, as opposed to a hard, deep recession, I think the soft landing is more probable. I wanted to touch on, this is what I alluded to in the very beginning. Here in our office, Len Fazio paraphrased a client and sent Jack a note, and I have a copy. And I'm going to read it word for word because it's so typical of things we hear as investment advisors throughout the year. And it was from a client, obviously I won't mention any names, said that his brother had been hearing some discouraging news about the stock market this year, about inflation, which we talked about, and a worsening bank industry. Also that some, in quotes, expert analysts are considering to sell investments to cash and to become more conservative in their investments. I just want to point out, before I let Jack answer on this, that on our side of the table as investment advisors, there's never a time. We are aware that there is never a time when there aren't so-called experts who say, sell, this is a good time to sell, move to cash, or, cut back severely on your stock investments. They'll be right. They are right sometimes. But there's never a time when you won't be sitting next to a plane who says, in a plane, a guy says he's in the industry. Oh, yeah, very dangerous time. There's always like 20 to 30% of the experts who feel very pessimistic. So we deal with that year in and year out. Jack, your take on that?
Well, I think it's an accurate reflection of, what kind of thinking has been going on inside the stock market over the last 12 months. And it largely explains why we've seen the decline we've seen. And I think, there is a bit of a drag going forward from the fact that you can earn, 4%, 5% on cash type investments. For some people, it's like, well, I'd rather, get paid that level of return on something that's no risk than to keep my money at risk in the stock market. But I think if you look forward over the next 12 months, and that's really what the stock market is trying to price in, we've got better times ahead. Inflation is slowly declining. The corporate earnings forecasts begin to turn up with the third quarter. And I think some of the investments the corporations are making probably helps. And as I've discussed in the past, we have continued strong buyback activity. So corporations themselves are bullish and continuing to repurchase shares of their own stock. So I think there's no question that there are some things that could go wrong and things that could be pessimistic, things that investors can be pessimistic about. But you know, this is why we don't market time. You don't know what's coming in the next 12 months. We've gone through a cycle where everything has been marked down, but I think we are at that point in the business cycle where things start to look up, and I think you know, there's probably more upside potential than downside risk at this point. So
I agree completely. And, you know, this person alluded to the worsening bank industry. Well, it's another example of the short-term news affecting, you know, people's long-term outlook, which it shouldn't. The banking industry had a scare now, you know, a month or two back. And it seems to have blown over mostly, but it's indicative of why I personally have been telling clients for 20 years, look at the stock market through a telescope, not a microscope. Take the long-term view. And when you do that, you realize what happens with a bank or two or three. It's just a hiccup in the long-term trend.
Yeah, I think what we had is a huge amount of fear over a pretty narrow problem. And, you know, in contrast with the 2008, 2009 financial crisis, where you had a
very different
over a serious real problem.
Right.
So I think, you know, it's more or less been contained. I think as we go on, we're seeing evidence that it may not even evolve into a credit crunch at this point. And some of the economically sensitive stocks that got marked down are now seeing a little bit of recovery finally. So I think, you know, this definitely caused a glitch in stock prices, but I don't think it is going to move the needle a lot when it comes to full year results. And I think if we're facing a broader and deeper crisis over the banking system, I kind of feel like we would have seen it already. I kind of feel like the system got tested. A lot of the reforms that were put in place in 2008, 2009, 2010 worked, and you know, we're kind of back on track at this point. That's my view.
Yeah, and by the way, the fact that they, my notes are mixed up. That as I said earlier, I think the inflation, the Fed will stop raising rates, and part of it is because of the banking industry. People are having trouble. We're hearing now they're having trouble getting loans for businesses. That might act as another hike in the interest rate without the Fed doing it.
Yeah,
because of the banking industry
a credit crunch in a very mild sense.
Exactly, and so that will tamp down economic activity. And therefore, that's another reason that I say I don't think the Fed will continue to keep raising rates, because if they look at what the banks are doing and holding down the lid on local businesses getting cash, that's going to slow the economy down. That's going to bring them to where they want to be in terms of tamping down the economy and the runaway inflation that some sectors are having.
Yes, it has likely reduced the terminal rate that the Fed needs to get to. But, you know, if they do feel it's necessary to do another quarter point tightening move, that's at least a vote in the confidence of the banking system itself. They're not worried about it and causing any additional problems. We've already dealt wisely with the problems that we had.
So let's, you know, we've already skirted around the issue of obviously interest rates, which takes us to bonds. We always want to give a sentence or two about your view of the bond market, since many of our clients have, you know, 10 or 20% in the fixed income market. Let's just talk about that for a moment.
Sure. One of the interesting things that's happened just in the last few weeks is that the yield curve has become less inverted, with short-term rates coming down a bit and long-term rates going up a bit. Bonds are still in a positive year-to-date situation, and I think given how much inflation got priced in and what likely is going to occur over the balance of the year, I don't think it hurts to be in bonds, and it might even be beneficial. So we continue to use bonds as a way to keep risk at targeted levels in our conservative portfolios. We have a large position in the actual US bond index fund, which we may increase depending. Other positions include kind of a conservative high yield bond bet, which is kind of a bet that the high yield companies are going to be in better position than they normally are for this kind of slowdown. And then also a short-term bond position in our more conservative accounts, simply for the reason that when inflation is licked, the short-term rates may be able to fall faster than long-term rates. But in general, that seems to be working, and it is helping this year a little bit. So we don't really have any major plans in store bond-wise. I think that, you know, a repeat of what we saw last year is extremely unlikely at this point, because bonds have more or less priced in all the bad news at this point. And as inflation gets back on track, there's probably some rooms for bonds to return more than just their income stream this year.
Well, I hope you're right. I'm a little more skeptical of bonds than you are, but just a little bit. So, you know, time will tell, and we'll see. You know, we'll meet everybody here in about 3 months. We do this quarterly now, and we'll see what happens. But I think overall things are a little bit more optimistic than, you know, 6 months ago, let's say, because of the inflation rate easing, and a lot of people are exhaling, you know, these days. You know, fingers crossed that trend continues, and it sounds like you agree with me that it probably will.
Yeah. I should also mention that another sign of things returning to normal is bonds moving the opposite direction of stocks. We're starting to see we'll get an up week with stocks, and the bonds will be down, and vice versa. So I think that's a healthy development as well. It indicates that the markets are looking beyond just the inflation problem at this point.
Yeah, good point. Good point. All right, everyone, we want to keep it to this time frame. We thank you for spending a little time with us. Happy spring, everyone. Thank you, Jack. We'll see you next time.